Morning, everyone. This is the Outlook Hedgeye's November investing webcast series. My name is Drago Mileshevich. I'm an analyst here on the Hedgeye Financials team, and I'm joined in studio, not in studio, but over webcast today by sector head Josh Steiner to review the current and emerging state of the domestic, financials, and housing sectors. And once we're done giving you a look underneath the hood, we're going to be taking your questions at the end of the call, which you can all freely submit in the question box below the video player. And without further delay, let me hand it off to Josh.
Great. Thanks, Drago, and thanks everybody for taking the time to be with us. So we did put some slides together. I wanted to try and cover a fair amount of ground here, so we'll get going on those. You know, the real focus today is going to be sort of fourfold. We'll take another look at our machine learning AI system. We'll go through our financials Quad Playbook. We will sort of think about the credit cycle and what the implications of that are. And we'll also take a look at the U.S. housing market. And really the idea of this presentation is that what we've done is we've selected 4 from the roughly dozen different products that are included in our Financial Sector Pro offering, just to give you a little bit of an idea and a little bit of a taste for what it is you would get if you were subscribing. So we'll start out with the Financials AI Stock Screener. So if we go ahead a couple slides here to, I guess, slide 3, you know, just to take a quick step back. So this has been a project that we've really worked on now for going on a little over 2 years. And essentially, in conjunction with our data science team, we built out an incredibly robust framework incorporating a little over 500 million data points. And what we produced is a machine learning system, an AI stock screener that essentially combs through roughly 350 different financial stocks. We also built one in parallel for the housing sector, although that's a smaller universe of around 50 to 60 stocks. And what I wanted to do is give a little bit of an update. So we've actually hosted a couple calls now in the last few months, sort of introducing the AI stock screener and also providing an update on the performance. But the last time we did that was about 5 or 6 weeks ago. So I thought we'd sort of revisit that. Obviously, there's been a tremendous amount of volatility in the markets, largely COVID related, partly election related, somewhat rates related. And so I thought it'd be interesting to go back and take a look at how this machine learning system has been faring through all of this volatility, this incredibly choppy environment that we've been in. So as a reminder, the idea here is basically that the system tries to basically treat the market, in this case, the 350 or so financial stocks, as it's called a classification problem. It basically tries to ferret out outperformers from underperformers. And so what it does is it says if a stock is going to finish in the top quintile of the overall group, that's defined as overperformance. And so then what it does is it describes an overperformance probability to each individual stock in the universe on a 1-year forward basis. And so if we look at slide 3, and the data is always changing, so what we do is we update it each week and we publish the output each Monday morning. And so each weekly output is its own discrete data set. And so what you see here on slide 3 is the chart on the left is the 1-month performance of the top 10 ideas that the AI generates out of that 350 stock universe. And on the far right, what we show is if you compounded that average 1-month performance from when we introduced the AI system back in mid-July to present, how would you have fared? And the results are really quite impressive. So if you had been putting each of these baskets on each week and rolling them on a 1-month basis from a compounded full year basis, the positive return here is 97.5%. And for comparison purposes, the XLF, which is the big financials ETF, if that were to be compounded on the same basis, would be up 17.9%. So very strong outperformance on the long side. And then if we go to the next slide, and we look at the delta between what are basically the top 10 and bottom 10 long ideas, which we treat as the top 10 longs and top 10 shorts. This is the delta. So in other words, if you're running a hedged book where you had the top 10 longs on the long side, top 10 shorts on the short side, the delta in performance between the longs and the shorts on a compounded full year basis here is over 35%. So that's pretty remarkable. Again, that compares to the 17.9% for the XLF. So even though the XLF has been trending higher, so that's obviously the directional dynamic, from a delta standpoint, you've got roughly 2x the performance going on a hedged book using this AI system as you would just being long the XLF. So obviously, in an environment where the XLF is going down, this system has, at least historically, been outperforming that very significantly as well. So I think that's pretty remarkable. If we take a quick, brief look back, just to maybe make that a little bit more tangible. So when we introduced this system back in mid-July, one of the examples we gave was Fifth Third Bancorp. So FITB is the ticker symbol there. And the reason we highlighted it is because, well, two things. One, it was screening very, very well in the AI system. And also, at that time, banks generally were, very out of favor. The banks have been performing extremely poorly, lagging just about every other sector in the market. And here was the AI system saying that Fifth Third was one of its top 10 ideas on the long side. And what this slide 6 is showing is the Tableau output that we get from the AI system for each individual stock. So in this case, we're looking at Fifth Third. And what you can see on the bottom left there, where it says forward 12-month line, is you see a series of lines. There's a yellow line, a brown line, a purple line. Those are the AI system's output for its overperformance probability. That's the yellow line, going back to 2009. So again, it generates this output every week, and that's how it's trended over that time frame. And so what's interesting is if you look at this sort of call-out bubble there, it says July 2020, Fifth Third Bancorp, FITB, average overperformance score 0.634. So if you go up to the top left there and you look at the 12-month overperformance buckets, this is how the stock has actually performed when it's in those buckets, those bins of overperformance probability. And if we go to the next slide, this is a blow up of that chart. And what you can see is that historically, when it's up in that 0.6 bin, there's only been a few instances when that's been the case, and most of them actually all go back to early to mid 2009. But the basic idea is that the stock was up over 200% in the following year, following readings when you've had this 0.6 overperformance probability. So, to go forward to slide 8, back in when we presented again our mid-July introduction of our AI system, this was the output at the time as dated as of Friday, July 10th. And you can see Fifth Third is listed there as one of the top 10 stocks. And if we go forward to slide 9, you can see how the performance since then has looked. So Fifth Third is actually up 44% in the 4 months since that presentation, which is pretty remarkable performance for a very out of favor sector like the regional banks. But what's more interesting is that Fifth Third, being up 44%, has really outperformed every relevant benchmark. So if you look at it compared to the XLF, for instance, the XLF is up 15%. So it's up roughly triple the XLF. The S&P 500 is up by 12%, as good as it's been. And so, we're up 3 to 4x what the S&P 500 is up. And then the KRE, which is the regional bank ETF, that one's up 28%. So that's a very strong performance for an overall group. But again, Fifth Third is up 44%. So roughly 1,600 basis points better than the broader regional bank group. So I bring that up just as an example of one of the names that we thought was very interesting back in mid-July because, again, it was like, well, back then, why does the market like this regional, or why does the AI system rather like this regional bank stock at this time when the market basically hates these stocks? And then, of course, there was a gigantic push yesterday with the announcement from Pfizer about the vaccine, and the regional banks were up roughly 15%, just yesterday. So anyway, on slide 9, at the bottom there, you can see that the average return for the top 10 ideas that were as of that mid-July presentation is plus 43%. So very strong relative, roughly 3x the XLF's return and almost 4x that of the S&P 500. So we think that's really good. And slide 10, we black these out. These are so we put this out every week on Monday morning. This is yesterday's output. Again, this is all available to our subscribers to Financial Sector Pro. You can go to hedgeye.com. It's easy to find it under the products categories. And this is one of, again, about a dozen different products that we offer with subscription to Financial Sector Pro. So on slide 11, this is one stock that I'll highlight right now just from an AI standpoint because it does also dovetail with our fundamental research view, and that's Visa. So I think most people are familiar with Visa. I won't really spend too much time on it. But the gist of it is that as of the output from yesterday morning, as you can see again on the bottom left there, Visa's current AI probability of outperformance is 0.575. That is very high, and especially relative to Visa's own sort of historical range. So if you look at that yellow line in the chart on the bottom left of slide 11, you can see going back to 2009, the outperformance probability of Visa according to our machine learning AI system. And you can see that where it is right now in the 0.575 range is at or near the highs that it's been in the last decade. And if you look up at the top left, you'll see how the performance has looked in these different performance bins. So if we go forward to slide 12, here you get a sense for when it's in these different bins, how has the stock performed historically on a forward 12-month basis. And as you would hope to see, and to an extent expect to see, as the outperformance probability of the AI system rises, in fact, you have generally seen the actual performance over the following 12 months get better. And so that's what we see here. So the 0.2 bin, the 0.3 bin, the 0.4 bin, the 0.5 bin, as those go up, the actual performance gets better. And with where the stock is right now, on average over the following year, the stock has been up about 41% in the following 12 months, again, on average, historically. And so that would be sort of our framework for thinking about Visa, just from an AI standpoint. Now, if we think about fundamentally what the implications of this are, well, the big overhang on Visa right now is really twofold. One is that, of course, we still have a fair ways to go from a spending renormalization standpoint. That's particularly on the credit side. Debit spending is actually largely recovered. One of the big areas of weakness for Visa and for MasterCard, for that matter, is cross-border travel. And that's not a big surprise. And that has to do with the fact that very few people, relative to, let's say, a year earlier, are traveling internationally. And so, of course, that's where the vaccine is going to come in a big way. But one thing to realize is that we run a weekly tracker on Visa and MasterCard's cross-border volume activity. And what we've seen in the last week actually is a pretty sharp acceleration. So it's gotten better by roughly 300 basis points on a week-over-week basis. And now it's trailing last year's activity levels by around 23 percentage points. So it's still way down, but that's really kind of the opportunity. So as you get a vaccine that's generally becoming more available over the course of 2021, what you would expect to see is really a large scale return to quote unquote normal levels of activity by 2022 and 2023. And that is really the sort of upside renormalization opportunity there for Visa. So just an example of how our AI system thinks about stocks and then how we sort of overlay what we think fundamentally on top of that. So again, we put out our AI output every week on Monday morning. We put the entire Excel output for all 350 stocks out there. So anyone who's interested, not just in what our top ideas are, but in any of the stocks in the sector can go into that Excel file and they can take a look and see what the system thinks about that stock at that moment in time. So now let's move forward here and transition to the Quad Playbook. So this is another offering that we include in our Financial Sector Pro product. So what is the Quad Playbook? Well, I think most people are familiar with how our macro team thinks about the sort of investing backdrop, and that is they use this sort of quadrant framework. So imagine basically 4 squares, 2 at the top, 2 at the bottom. The 2 at the top represent environments of accelerating growth, and the 2 at the bottom, decelerating growth. The 2 squares on the right represent environments of accelerating inflationary pressure, and the 2 squares on the left, decelerating inflationary pressure. And the reason that's relevant is because it's really an eye into what the Federal Reserve is likely to do. Obviously, the Fed has enormous implications, not just for the market, but for financial stocks in particular. And so on the basis of that, slowing or accelerating growth and slowing or accelerating inflation, you end up either in Quad 1, which is the top left. That's weakening inflationary pressures with a favorable growth backdrop, or Quad 2, where growth is accelerating and also inflationary pressures are accelerating, or Quad 3, where growth is slowing and inflationary pressures are rising, that's stagflation, or Quad 4, which is growth is slowing and inflationary pressures are receding. So depending on which quad you're in, or maybe more importantly, which quad you're heading to, that really helps inform how you should be thinking about positioning. And so if we go to slide 14 and we look at the lay of the land here, basically what you have is a snapshot of different subsectors across the financials landscape and how they perform in different quad environments. So Quad 1, 2, 3, 4. And as you can see on the left, these are the average returns in these different quad environments for these different subsectors, as well as the overall financials complex at the top and the S&P 500 there as well. And, not surprisingly, Quad 1 is the best performing environment for financial stocks. That's an environment, again, where growth is accelerating and inflationary pressures are receding, meaning that the Fed is generally easy with monetary policy. So that's really kind of a Goldilocks environment. The worst environment would be Quad 4. This is an environment when growth is slowing, i.e. recessionary environments. And at the same time, you have the inflationary pressures are abating. And so the Fed is easing. And so basically you have a falling or flattening yield curve. And you also have credit losses that are expected to be increasing. And that's generally going to be a tough environment for most, though not all, financial stocks. So if we go forward a slide here, slide 15, Quad 3 was really the environment we had been in until really just recently. Quad 3, again, is an environment where growth is slowing, but inflationary pressures are rising. And again, that's really a stagflationary environment. This is not a great environment for most of the financials complex. There are exceptions. For instance, if you look at the top right of this chart, you see open loop payment networks. So what is that? Well, open loop payment networks are Visa and MasterCard. So not surprisingly, these guys do, frankly, just fine in a stagflationary environment because, again, those companies benefit from inflationary pressures. If we go forward a slide to slide 16, actually, before I go forward, let's go back to slide 15 again. So you've got Visa and MasterCard, the open loop payment networks at the top right. Well, at the bottom left, you've got the debt collectors. So these are companies like Encore Capital and PRA, ECPG and PRAA. So these are some of our favorite names on the long side, fundamentally. And I can explain that in more detail later. But from a quad setup, at least historically, the stocks have performed quite poorly in quad 3 environments. And that's just sort of a fact. That's the way it's looked. However, if we go forward to slide 16 and we look at the quad 2 setup, first of all, it's radically different than the quad 3 setup. So the axes on these charts haven't changed. The y-axis is still +10 to -6, and that's not annualized performance. That's quarterly performance. And what you can see if you toggle back and forth between 15 and 16 is that the entire group has shifted up and to the right. What does that mean? It means that the entire sector likes quad 2 better than quad 3, and that shouldn't come as a surprise. Quad 2 is an environment of growth accelerating. Quad 3 is an environment of growth decelerating. But the relative position within those landscapes also has shifted. So I mentioned earlier on slide 15 that the debt collectors were the worst performing sector in quad 3. Well, in quad 2, they're actually among the best performing sectors. They're right up there with the open loop payment networks. So what a difference a quad makes. And so this is one way people can think about how to sort of envision shifting quad dynamics or regimes in the quarters ahead. You can take these playbooks and you can look at not just the subsectors, but the individual stocks within those subsectors and think about how the setup over the coming 1 quarter, 2 quarter, 3 quarter time frame looks. So I want to shift gears here and I want to talk about the credit cycle. And one thing that we have a lot of products that track the credit cycle, but one of them that's timely and topical because it actually came out yesterday afternoon is the Fed's quarterly senior loan officer survey. And so this is something that we put together analysis on every quarter, as well as a bunch of other things. And this is kind of an excerpt from what we put out each quarter. So again, this came out yesterday afternoon, so the data is very timely. So slide 18, really the survey breaks down into 2 major categories. You've got commercial lending and consumer lending. These are the 2 big categories. On the commercial lending front, it's really red. What does red mean? Red means that a net percentage of lenders are tightening their lending standards. They're raising their pricing, aka increasing spreads, and they're reporting a reduction in demand on the part of borrowers. So all those things are negative. Commercial real estate side is really the same dynamic. They don't have the spread question in here. They just have standards and demand. But generally, red is bad, green is good. And as you can see, things are just red across the board. So that is an environment that is not a particularly auspicious backdrop for the commercial lending setup. However, if we go to slide 19, it's a little bit more nuanced than that. So this is a chart that goes back to 1990, and it looks at, again, the net percentage of banks that are tightening standards for C&I loans. So again, tighter standards means tougher to get a loan. That is a constrictive or shrinking environment for access to bank credit. So anytime you see this line going up, it means that we're going into a recessionary environment. Now, it's kind of a diffusion index. So anything above 0 in this case means that standards are still tightening on the margin. Anything below means that they're easing. However, if you think about it from a equity price standpoint, meaning how are the stocks acting, even though you're still in a tightening environment, once you roll over and cross that sort of peak level of tightening, generally you start to see the stocks outperform. And that's exactly the environment we're in right now. So even though it's still a very restrictive lending environment, we do appear to be, at least for now, past peak. And you can see how these prior peaks have looked going back to 1990. And that's really the frame of reference that you should have. If we go forward a slide, this is the pricing of money. So this is what banks are charging. So basically the spread they're charging. Are those spreads widening or contracting? So not surprisingly, when you're in a recessionary or slowing growth environment, banks are charging more for credit. When you're in a growth environment and credit is plentiful, they're charging less. Again, we're still in an environment where banks are charging more, but we are also sort of rolling over here, and that's an equally important takeaway. On slide 21, this is the percentage of borrowers reporting increased demand, or really the percentage of lenders who are reporting increased demand from borrowers. And so this one is less auspicious because the numbers are still rolling over negative, meaning that fewer and fewer commercial borrowers are looking for bank loans. And so that on the margin is a negative. So what do we do with all that? If we go to the next slide, slide 22, this is a snapshot looking back historically at the relationship between the C&I questions in the Senior Loan Officer Survey and the economic backdrop. And what we found, looking back historically, is that anytime you have two of the three questions roll from basically what we would call expansionary to contractionary, you've ended up in an economic contraction or recession. And this instance is no exception. So this is how to sort of think about it from an economic backdrop. If we think about it from an equity price standpoint, and we go to slide 23, this is really just a snapshot at the standards question, are you increasing or reducing lending standards? And how does that look relative to the S&P 500 financial sector index, meaning equity prices on the right-hand side there. And as you can see, the two tend to follow each other very closely. So as I mentioned, even though you're in a contracting environment, meaning that standards are still tightening on the margin, i.e. you're below that zero line with your light blue and dark blue lines, meaning that standards are still tightening. If you've rolled over past the sort of apex, or I guess in this case, the trough, the nadir, then you're in an environment where you're basically past peak from a contractionary standpoint, and things are starting to ease up on, this isn't really a second derivative concept, but that's the idea. And so that's kind of where we find ourselves right now. If we switch gears and we look at the consumer side on slide 24, it's really a tale of two cities here. So the residential mortgage lending environment has been very strong, frankly, for quite a long time, since essentially the fourth quarter of 2018. And what we saw was a very brief pullback window early on in the COVID lockdowns. It lasted about 4 weeks, not very long. And then since that time, housing has been one of, if not the best performing sectors, like right alongside tech, as people have basically realized that they're spending more time in the home. If they're cooped up in an apartment in a multifamily setting, they want to be out in the suburbs with a home office and a backyard and that sort of thing. So that's really what you see in that green sector where stronger demand being reported for mortgages. However, alongside that stronger demand, you've seen a general tightening in access to credit, and that's really been across the board. So GSE eligible means Fannie and Freddie, government means FHA, VA, and then you have a lot of other sort of subcategories that I won't dwell too much on. I think most people are familiar with subprime. But the idea is that even though there's been more demand for obtaining mortgages, the ability to access mortgages has been getting tougher. And so really what you're seeing is only well-qualified buyers able to go out there and purchase homes. And then at the bottom, you have basically the the consumer non-mortgage section, which would be things like credit cards, auto lending, consumer loans, ex auto and card. And here you've seen sort of a similar dynamic. You've seen standards tighten. You've seen demand falling. So if we go forward and take a look at a few of these, slide 25. So this is the net percentage of respondents who are tightening standards for mortgage loans. So again, you can see it shot up there in the second quarter, but in the third quarter, it came back down. So we're kind of coming around the bend there. The demand for mortgage loans has been really hooking up and to the right, as I mentioned, ever since the fourth quarter of 18. There was that brief drawdown in the first quarter, but since then it's kind of been off to the races. And then if we look at the standards of on consumer loans generally, so here we've got on slide 27, credit cards, consumer loans excluding credit cards, new and used autos, kind of an interesting dynamic. So a couple takeaways here. One, you saw this massive tightening of standards in the second quarter, still tightening in the third quarter, but again, less so on the margin. And that's maybe the more important takeaway. The other thing I would take away from this is that if you look at the trend lines here going into the last couple of recessions, so standards had really been easing through the late 90s going into the early 2000s. So that sort of set the stage for pretty poor performance in that recession. And then the same dynamic occurred the following cycle. You had this sort of general easing of standards really from 2001-2 all the way up through 2006. And that helped set the stage, of course, for the financial crisis. It has been a little different this time around. So if you look at the trends from 2012 through about 2018, you can actually see that standards were on the margin getting a little bit more restrictive going into the downturn. And I think this is one of the reasons why we've seen credit quality, at least on the margin, performing a little bit better this cycle, in spite of the unemployment numbers, than in previous cycles. If we go to slide 28, this is on the consumer loan side, really the demand side, and this is sort of the obverse of what we were looking at a second ago. Part of the reason that, again, you're seeing better performance is that the demand for credit outside of the mortgage landscape over the last several years has actually been trending lower. So if you look at that sort of trend line across whether it's auto or card or all consumer loans, from really the 2012 to 2018 timeframe, it had been trending downwards. So that on the margin is going to create a little bit of a softer landing environment, notwithstanding obviously what's happening on the unemployment front. So this is another thing that we provide as part of our Financial Sector Pro offering. And then I wanted to hit on one more topic before we shift gears and go into taking any questions. And that is another thing that we include in the Sector Pro offering is a look at the U.S. housing sector more broadly. And I've been doing this for a number of years now. And frankly, I think we've gotten pretty good at it. And the idea here is really playing around with the big sector ETFs. So XHB, ITB, these are the big housing proxy ETFs. The big difference is XHB has a little bit more relative exposure to the home improvement stores, Home Depot and Lowe's, and ITB is a little bit more heavily exposed to the home builders, so the DR Hortons and the Lennars of the world, among others. And really the way we sort of try to frame up the housing market is, what is the outlook for housing from a macro standpoint, looking ahead 1 quarter, 2 quarters, 3 quarters, a full year ahead, and so forth. And we do these big institutional calls every quarter where, frankly, we put together about 150-page slide deck each quarter, and we go through just a massive amount of data and trends, and here are the different things to think about, and what is the most probabilistic path of these different dynamics and so forth. And what we do in the Financial Sector Pro product is we really try to sort of curate and distill that down into, a much more sort of tangible framework so that, we don't kill people with nuance. And so slide 30, I've got just a couple of slides in here, just a handful of slides that basically are sort of taken from what we do each quarter. as part of the Financial Sector Pro offering, just to illustrate. But slide 30 I thought was an interesting one because it shows just how stark the performance in the housing landscape has been. And what's really remarkable about it is that if you go down to that table on the right, at the bottom there on the left under 1Q, what you can see is that in the first quarter, housing stocks were down 37% in that quarter. That's not an annualized number. That was their worst first quarter on record in the last 20 years. And importantly, they were the worst performing sector, or housing was the worst performing sector. If you fast forward to the second quarter and the third quarter, those were the best second and third quarters, or just about on record in the last 20 years. And not only were they the best for housing, but you can see how housing performed, not just in the third quarter. So if we look at the charts on the left there, in the third quarter, housing was the best performing sector in the entire market. And year to date, the performance in housing was so strong in the third quarter that it actually took the year to date performance all the way up to the top of the leaderboard. So right there with XLK, which is technology. So housing is an incredibly volatile sector that can absolutely be traded on an intermediate term, i.e. 1 quarter out basis. And when you have a good framework for thinking about, what are the dynamics, what's going to cause it to go up or down probabilistically, you can do really well in trading the housing sector. And so that's why we do this. This is, again, something we include in the Financial Sector Pro offering. So slide 31, this is just a sort of a compendium table of all the fundamental data across the housing landscape. Obviously, green is better, red is worse. You can see the setup here. If we go to slide 32, a lot of what we espouse at Hedgeye is rate of change. And you can see on slide 32 how we sort of went into the COVID cliff early in 2020. And then, of course, coming out of the COVID cliff, you saw this enormous resurgence and acceleration in all the data. And that sort of made it increasingly clear that housing was going to be, and of course was, this massive winner coming out of the COVID cliff. And then one of the things among many that we look at with housing, because it's so sensitive to interest rates, just like it is in financials, is, what are the various setbacks or setups looking backward, how those looked for the housing sector. So just by way of illustration on slide 34, this is sort of a look at positive rate shock analogs, meaning that when rates have gone down sharply on an expedited basis, what has happened both fundamentally and from an equity price performance. So this goes back to 1993 and looks at prior periods when rates had come in very sharply, as they did from December of last year through September of this year. Rates were down 92 basis points. And you can see these prior periods down 118, down 81, down 203, down 200, and so forth. If we go to slide 35, you can see in the fundamental landscape that those declines in rates have produced very swift upticks in sales volume. So not surprising. This is one of the primary vectors that the Fed has from a monetary policy standpoint to get things going. And so, of course, housing is on the front line of that. And so we see, the same way it's played out in the past, it played out again this time, not a surprise. And from an equity price standpoint, on slide 36, the performance, again, off the COVID troughs for housing equity is very, very strong, up 74%. If we look back at prior periods, up 43, 26, 68, 35. So again, what we try and do is really frame these environments so that you can sort of think through what is reasonable to expect. And then we try to always leave, a sort of bull case and bear case framework for thinking about where things stand. And I won't read through everything on slide 37, but you can certainly take a look. Basically, we map out, as we see it, the fundamentals and the equity setup, both positives and negatives, and thinking about the sort of path forward. So I've covered a lot. I don't want to take up the entire time here, just rolling through slides. So if there are questions, we can go through those.
Great. Thank you for all that, Josh. Yeah, we got a long queue here. Let's just start big picture. What is your broad outlook for domestic banks over the short, intermediate, and longer term?
Yeah, so your banks are a pretty interesting sector right here. I think suddenly with the virus or the vaccine yesterday, you really have this sort of different, setup, I guess, than you had even 48 hours ago. But the basic challenge that banks are facing right now is threefold. So one is banks have a huge liquidity problem, and it's a funny liquidity problem because it's not the kind of liquidity problem that you would normally think about with banks. Banks have taken in, since the start of this year, about $2.5 trillion in deposits. Meanwhile, they've lent about $350 billion. So $2.5 trillion in deposit money. This is both commercial and consumer, and $350 billion out in the form of loans. Now, of that $350 billion that's gone out, most is C&I lending, and of that C&I lending, most is PPP money. And what do borrowers do with PPP money when they get it? Well, they deposit it back at the bank. So that doesn't really solve the problem. The other thing they've done with the money is they bought about $300 billion worth of agency mortgage-backed securities, so Fannie and Freddie securities. Problem with that is that with rates coming in so quickly, the prepayment speeds on agency mortgage-backed securities have gone through the roof. Basically, people are refinancing at record rates. And so, banks are basically stuck with huge amounts of deposits that they can't lend out because there's just not a lot of demand for loans. And banks are still gun shy from a credit standpoint. And there's not a lot of vectors for them on the security side because on one of the major ways you go out and you put money to work from a security standpoint is, of course, through agency mortgage backs. And so those are prepaying like crazy. And so the challenge is, what do you do with all this excess liquidity? And the answer is there is no easy solution. Normally, when rates have come down as much as they have, you would see both consumers and commercial institutions going into risk assets, i.e., taking money out, borrowing money, and you're just not seeing that right now. And so this is appearing to be more of a structural problem. And what are the negatives of having too much liquidity? Mainly, it's net interest margin. So the margins at these banks are under severe pressure. They've been under severe pressure really since early this year. And that pressure isn't going away anytime soon. So that's the first problem. Second problem is credit. So a couple of weeks ago, in the middle of earnings, we got a great comment from Richard Fairbank, who's the CEO of Capital One. And what he said is that in his 30 years of building Capital One, he's never seen an environment like this, meaning never seen an environment where the labor market backdrop and general macro backdrop have been as disconnected from credit metrics as they are. And of course, the reason why has mainly to do with government transfer payments, whether it's in the form of PPP money or extended unemployment or enhanced and extended unemployment benefits or stimulus checks. This has created this enormous bridge, particularly for consumers, but also for businesses that really hasn't been there in previous cycles. And so, obviously, this next round of stimulus represents an enormous linchpin for whether this sort of disconnect between fundamentals and credit can endure, or whether we're going to start to see some element of sort of catch up or renormalization. So that's the second thing to think about. And then the third thing to think about is the banks are under a lot of pressure from fintech. So I have a couple of statistics here that I think are, sort of hit it home, the challenges banks are facing on the fintech front. So the first is that in the US, online banking registrations rose 200% in the month of April. At the same time, mobile banking traffic rose 85% in the month of April. So if you think about sort of valuation and where is the value being ascribed across the sector, it's been an incredible transformation, not just in the last year or two, but really over the last decade. So here are a couple of numbers. So I have to look over here to reference them, but think about these. So this year, 2020, traditional banks are making up 72% of the total market value of the global banking and payments industry. And that's down from 81% the year before. So fintechs within that account for 11%, and payments companies account for the rest. By comparison, back in 2010, that number was 98% of the total market value for banks. Now it's 72%. So in 10 years, the banks, traditional banks, have gone from being 98% to 72%. That is a trend, and that is a trend that is not likely to reverse. So you can pick your spots, and whether it's a vaccine announcement or a rate shifting dynamic or a sort of credit trend reversal, you can certainly pick your spots. And I gave an example with Fifth Third earlier from our AI stock screener that I think is super interesting. But the overarching trend is that the pressure that is on banks is not going away anytime soon. So keep that in mind. One thing that is going to happen that's going to be interesting is that there is probably going to be a lot of bank M&A over the next couple of years. And why is that the case? Well, it's primarily the case because net interest margins are under so much pressure. So when your net interest margin is under a lot of pressure, one of the ways that you can deal with that is by focusing on your non-interest margin. So what is that? Well, basically everything other than the simple business of taking in deposits and lending out money. So how do banks improve their non-interest margin? Well, one way is they reduce their branch footprint costs. So what you'll likely see over the next couple of years is you will see banks with overlapping branch footprints, meaning that, a bank that's primarily, for instance, in the Southeast, and another bank that's primarily in the Southeastern U.S. With a lot of branches in the same markets are going to get together. And they're going to get together because they can eliminate half of those branches and not lose deposits. And their operating costs are going to go way down. And of course, all of the investment, all of the technology going forward is really going to be on the mobile side. So, I mean, if you think about it, millennials basically hate anything that's not on their phone. Nobody wants to go into a branch anymore unless you're over the age of 50. And this is the future. So banks are going to consolidate. The challenge with that is banks are rarely bought. They're almost always sold. And in order to sell a bank, a CEO of a bank has to feel like he's getting a reasonably good multiple for his bank. And consider this. In 2019, in the first 9 months of the year, there were 200 bank M&A deals, and they took place at an average price to tangible multiple of 1.6 times. In the first 9 months of this year, there have been only 81 deals, and they've taken place at an average price to tangible multiple of 1.3 times. So until we got to this vaccine announcement yesterday, there wasn't a lot of hope for bank M&A because even though banks need to consolidate, the multiples didn't justify it from the standpoint of the sellers who are really in charge of the process. Now that banks are suddenly seeing some multiple expansion here because the curve is steepening all of a sudden, you are likely to see a resumption in bank M&A. So that's, I think, the broader backdrop here for banks.
Great. Thanks for all that detail, Josh. And maybe moving over to the world of unsecured consumer credit, how are you thinking about the card lending names at the moment? Is it a value play or a value trap? What are some things to look out for?
Yes, I think, the card lending stocks are interesting right now because they've had massive short squeezes on the vaccine announcement yesterday. And, you've got this sort of environment where, at least in my mind, and I'm not really any kind of vaccine expert or expert on the timeline or anything, but my general sense is that there is a large disconnect right now between when the average person is going to be able to get a vaccine in 2021 and the path that the virus is on right now. In other words, the number of cases is rising very quickly. More and more places worldwide, but also in the US, are sort of getting closer to, if not already, sort of embracing some new form of lockdown. So all of this puts pressure on jobs, puts pressure on spending, puts pressure on general activity. We also seem to be in this sort of stalemate over stimulus. So obviously we're in this sort of post-election period here where, there hasn't really been any indication from the Senate that they're willing to kind of take up anything sort of meaningful on the stimulus side. And that still seems to be what the House is looking for. So, obviously you have this sort of held up transition process on the part of the presidency. And so, the prospects for stimulus in the short term seem bleak. And so you've got sort of virus cases ramping back up. You've got stimulus unlikely. And from my perspective, you have a vaccine that, while it's now on the horizon, which is great, probably isn't going to be generally available for quite a while. And I think what that creates is sort of a recipe for this sort of time and space dynamic that's going to become a big disappointment in the short to intermediate term, meaning that, there's going to be a lot more pain before we get to the other side of this. So I think that's the sort of short to intermediate term challenge in the setup for the card companies. And I think, once you look beyond that, then they possibly become interesting again on the long side. But between now and then, our view is that these still have a lot of downside.
Got it. Moving on, got a lot of interest in the debt collector names. So I'm going to bundle two questions into one here just because the answers will surely overlap. So firstly, what is happening with Encore, ticker ECPG? And secondly, can you provide an update to the regulatory outlook for both Encore, ECPG, and PRA Group, ticker PRAA? The fundamentals look good, but the trend is not confirming this. How big are the risks from increased CFPB scrutiny?
Yeah, so maybe for those unfamiliar, I'll take a step back and I'll explain a little bit about the mechanics of the timing and the cycle as it relates to Encore and PRA. So if you go back in the last few cycles and you look at the performance of different subsectors of financials, the debt collectors stand out because historically they have been the best performing subsector of financials early in the cycle. And the reason why that's the case on a recurring basis is because generally the supply of charged off receivables goes up late in the cycle. So unemployment goes up in a recessionary environment. That causes delinquencies and charge-offs to go up. That causes primary lenders to sell off increased share of those charge-off receivables to what are called third-party collectors, in this case, Encore and PRA. And then they buy more paper, and then over time, the employment environment gets better, and that improves the collectability of the paper that they bought. And it really has a lot to do with supply and demand. So like anything, when there's a lot of supply and not as much demand, the pricing you, the debt collector, get purchasing that charged off paper is a lot lower than in the opposite environment when there's not a lot of supply and there is a lot of demand. And so I think what's happened really in the last month or two is that you've had this sort of stymieing, I guess, of what was expected to be this significant buildup in delinquencies and charge-offs here, really by now, by the end of 2020, based on the fact that about 30 million people filed for unemployment insurance. I think one of the big differences is that this time around, unlike previous periods, the 30 million people who were collecting unemployment insurance, at least through July, were collecting a supplemental $600 weekly enhanced unemployment benefit check on top of the average $381 benefit. So the average recipient of unemployment insurance was earning around $600 a week at their job. And then from really the time they started collecting through about the end of July, they were collecting close to $1,000 a week. So, that obviously was very stimulative. Then from August to September, that $981 weekly benefit dropped by $300 to $681. And after August, it dropped all the way back down to $381. So you're in this sort of transitional phase right now where people are, you still got a very large number, well north of 10 million people collecting unemployment benefits, actually north of 20 million people. And the issue is going to be, what's going to be in the stimulus bill to keep that sort of going. And as I touched on earlier, the prospects for stimulus in what I would characterize as the short to intermediate term are not particularly good. And I think the fact that the Senate looks unlikely to flip is going to really give Republicans the upper hand in this negotiating process around the stimulus. And they're certainly indicating that they want to keep the size of the bill down. So ultimately, I think that is going to weigh on the prospects for the next 6 months to look like the last 6 months from a benefit standpoint, government transfer payment benefit standpoint. And so I think that's going to weigh on the delinquency rate, the charge-off rate, and ultimately the amount of paper that's sold off to Encore and PRA. As far as the quad setup, I touched on this earlier in the presentation, but we've really been in this stagflationary environment here, and that has, at least historically, been a very poor environment for debt collectors. Now, or at least in the near future, it looks like we're going to be transitioning into this Quad 2 environment in which the debt collectors have performed historically very, very well. They're among the best performing sectors in financials. So, I think those are a few of the different things. There's obviously cross currents, but those are the big things that people are focused on. Touch on regulation real quickly. So the concern here is that with the the transition to the Biden administration, you're going to have this sort of rebooting of the Consumer Financial Protection Bureau. And who will be in charge of it, we don't know. But the idea is that it'll go from being this, sort of largely disenfranchised agency back to being this sort of consumer watchdog powerhouse. So I think there's an element of truth to that. I think what is sort of auspicious on the margin for the debt collectors in that sort of framework is that they've actually been dealing with the CFPB on a broad-based debt collection regulatory reform for the last few years. And actually, the draft results of that were released about 18 months ago. The companies have both been compliant with that, with those draft requirements for the last year and a half. And the final rule set was promulgated just recently. And that goes into effect a year from now, although the companies are already compliant with it. So, what I'm saying is that the CFPB has basically just dealt with the debt collectors. So it seems not impossible, but less likely that under this new regulatory framework, they would be sort of right back on the front burner again here in this new administration. So I don't know that the market is seeing it that way. I think the market's probably being more cautious in that respect, but that's how I see it.
Got it. And we'll take one more here, bundle two again. We got, it's on the domestic housing front. So we have Raphael from Dunkirk, France, asking, where do you see housing going if rates rise next year? And then Henry from Seattle asks about the probability of a housing price recession due to high and increasingly permanent unemployment.
Yeah. So, okay. So let me start with the first one. The first one is really rates. So what you have right now in the U.S. housing landscape is an environment where you're at record low levels of inventory and at or near record high levels of transaction volume. That is going to restrict the ability of total sales volume to go up from here. So what you're likely to end up with is a rate of change that's going to slow, at least for a little while. And then, of course, it's going to speed up again when it starts to run up against those very easy early spring 2021 comps, which are, of course, going to be comping against that COVID cliff period. So that's kind of the rate of change setup. As far as rates are concerned, when rates move significantly, either up or down in an expedited fashion, meaning you get a large rate change in a short amount of time, rates become the single most important factor for housing stocks, more important than anything else. So an analog would be over the course of 2018, the fundamental backdrop for housing was incredibly favorable. The stocks were working incredibly well. And then all of a sudden in the fourth quarter, you had this sort of sharp reversal where all of a sudden, the dynamic from a rate standpoint basically inverted, and you saw it immediately in the stocks. And so the thing I would sort of think about and frame up here is that the fundamental backdrop for housing right now is still very strong. It's probably not going to get better, barring the COVID cliff, because you've got low levels of inventory and peak levels of activity. So now rates are going up, at least they appear to be, on the basis of the last few days, and I guess in the context of the last few weeks. And so the issue becomes, if rates move up, generally the threshold has been you need like a minimum of 50 basis points. And I'm not talking just about the 10-year, but in the actual 30-year fixed rate mortgage. And that hasn't really budged yet. If you get that, you are going to see a sharp reduction in transaction levels on the fundamental side, and also in housing equity price performance. That's the way it's always been. That's not likely to change going forward. So again, if rates, so right now you've got the 10-year up around 90, 95 basis points. I would say that if that were to get up in the sort of 1.25 to 1.5 range, and you were not to see a significant change in the spread between the 30-year fixed rate mortgage and the 10-year treasury yield, then that would be the threshold at which you would really start to see pressure on the housing stocks. As far as home prices, this is a very different setup. So home prices are skyrocketing up right now across the country. The home price indices, like Case-Shiller, S&P Case-Shiller, don't yet show this because they're very lagged. They're like 4 to 5 months lagged, but they will catch up. But the more contemporaneous things like median home price sales and so forth are showing home prices rising anywhere from 10 to 15% year over year right now across the country. So extremely strong home price appreciation. And that's even with major metros like New York City and San Francisco, where prices are actually falling very quickly. If we think about the setup, why that's happening, it's just a simple function of supply and demand. So you have record low supply, record low levels of existing homes inventory for sale, and you have record demand for homes. So the release valve on that is price, naturally. And at the street level, it manifests as every time a new home comes on the market, you've got a bidding war. You've got people hunting around for homes before they even go on the market. It's so tough to find a home for sale in a lot of markets across the country. And a lot of this is being sourced by people basically looking to decamp from urban multifamily setups, i.e. apartments in cities, moving out to the suburbs and exurbs, looking for more space, as I talked about earlier. The outlook for price going forward is probably not as strong. One, because rates are backing up a little bit. Two, I think there was sort of an initial push of this deurbanization trend in the immediate wake of COVID. I think that's going to be a durable push, but at a slightly lower level of activity. So I think on the margin, that's going to slow down a little bit. And then I think you're also getting an interesting dynamic here on the inventory side, where one of the reasons people weren't really selling is because they just didn't think they were going to get all that much money for it. But all of a sudden, the market's so hot that you're actually starting to see a little bit of sort of reflexive behavior where people are starting to sell or starting to list because they're like, well, now's a great time to sell if you're going to sell. So that's getting a little bit less bad on the margin. The other component of that question was, you've got millions of people who are delinquent or in forbearance on their home loans. And is that going to trigger a collapse in home prices? And there, I think the answer is probably no. And the reason why is because one of the underappreciated things in the market has really been the sort of growing presence of the institutional bid for homes that are basically in an REO type status, real estate owned status. What I mean is this industry didn't really exist prior to 2010. Basically what happened in the financial crisis is you had millions and millions of mortgages go delinquent and ultimately default into foreclosure, and then basically became real estate owned on bank balance sheets. And this cottage industry was born from the Blackstones of the world and the Carlyles of the world, basically private equity firms, where they went and they created an institutional bid for foreclosed homes. And they went out and they started buying not just 10 or 20 or 100 homes, but thousands of homes in markets across the country. And they bought these in these sort of 5 to 7 year funds. And it was a great investment, a fantastic trade. And we always assumed that when they got to the end of that sort of 5 to 7 year window, that inventory would be liquidated and those homes would come back on the market. But that's not what happened. Instead, you sort of in parallel had this new industry come on board, which is basically the single family REIT sector. So this is basically when you want to live in a house in a suburb, but you don't want to own it, you just want to rent it. Or maybe you just can't afford to own it, but you can rent it. And so now companies own thousands of homes across the country in this single family rental model. And so basically what you've got is tens of billions of dollars of dry powder out there on the part of private equity firms, as well as billions of dollars of dry powder on the part of these single family rental REITs who are, literally they're champing at the bit to go out and buy up all these homes as soon as they hit the market. So clearly they won't buy them all, but what I'm trying to say is that I think the setup this time around is very different and much more favorable than the setup was in the financial crisis. I think there are going to be far fewer, basically you're not going to have this crush of inventory. Like, to put it in perspective, at the peak of default back in early 09, early 2010, the US housing market got to almost 12 months of supply of homes for sale. And a lot of that had to do with all this defaulted inventory. You literally had like 7 million houses that were in default. Right now, you're below 3 months of inventory. So even if that number were, let's say, to back up to like 4 months, because you get this big wave of supply over, call it an 18-month time frame from like spring of 21 through fall of 2022, that wouldn't be anywhere near what happened in the last go around. And I think a lot of the reason why is you have this giant institutional pent-up demand to buy these homes. So I think the outlook for prices is a lot more robust going forward than it was 10 years or so ago.
Great. Thank you, Josh, for captaining us through all of that. I'd like to say, for more information about our process, we invite you to check out the financials we invite you to check out Financial Sector Pro. It's our premium research product designed to help investors risk manage the vast and diverse financials complex. And with that, I'd like to Thank our audience for tuning in to the financials edition of the Outlook, Hedgeye's November webcast series. Look out for more sector spotlights coming your way.